Welcome to the Flip Side Podcast. I'm Brad Rogoff, Global Head of Research. Today, we have a very special Flip Side episode. I am very happy to be joined by the former host of this podcast, Jeff Meli, who is now an NYU Stern School of Business Clinical Professor of Finance. And if we're inviting Jeff, we got to talk about one of his favorite topics, how bank regulations are changing and what it might mean not just for banks, but for financial markets.
Well, thanks, Brad. It's good to be back here at Barclays. And I do love this topic, part because I find it really interesting and partly because I think it's extremely important for everyone to understand.
Okay, Jeff, as excited as I am to talk about this, before we get started, I got to give a full disclosure here. Barclays is a global, systemically important bank that operates in jurisdictions subject to prudential banking regulations. Our conversation today discusses changes to the U.S. implementation of the post-global financial crisis bank capital framework, as discussed in independent research reports published by Barclays Research Department. The views that we will express on this topic are our own and do not reflect the views of Barclays Bank PLC. So, Jeff, let's talk about the changes that are proposed. There's a bunch of them. You said you think they're important. Why don't we do a little background setting here before we go into some debate?
Robust bank regulation is incredibly important to the economy and to financial markets. So banks, which are some of the most regulated entities in financial services, they safeguard deposits. That's a huge fraction of consumer savings. Banks make trillions of dollars of loans. They loan money to individuals. They loan money to corporations. They loan money to governments. They also provide liquidity in financial markets. They buy and sell assets from investors, and investors need that because sometimes they want to get out of positions or initiate positions, and they rely on banks.
So that's good table setting. And all of those things have been true for a very long time. But what we found out in 2008 was that maybe the level of safeguarding wasn't as robust as it could be. So let's take a little trip down that memory lane. The rules governing banks were totally revamped after the global financial crisis, having learned that the old version allowed banks to become extremely risky, and that required massive taxpayer-funded bailouts.
Yeah, the most obvious change was requiring banks to use more equity financing. That means they're less levered, and less levered means they're safer. But there were a lot of other changes too, like to supervision, the way regulators examine banks. All of these together were really designed to improve the stability of the system.
So one important change I want to hit on, but it wasn't necessarily the most obvious one, was a new limit on banks' exposures to low-risk assets, actually, as opposed to high-risk assets. And this was designed to stop the repeat of 2008 when banks owned highly structured assets that were actually highly rated and therefore looked very safe but had serious hidden risks. So it's necessary because historically bank capital charges, or the amount of capital that they had to hold to absorb unexpected losses, were based on the risk of their assets, which can result in very high leverage for banks that own assets that appeared to be safe, especially by those ratings.
Yeah, regulators made some other changes too. They introduced, for example, stress tests. A stress test is where the regulators impose some sort of a hypothetical market shock on the balance sheet of some of the largest banks, and they test to see if the bank is capable of wistanding that kind of volatility.
Okay, so that's the trip down memory lane. Let's bring it more to the present, right? So the new rules, they seem to have worked from a safety standpoint, but what we're now seeing is U.S. regulators revisit some of these constraints. So the most prominent changes that we're seeing involve the enhanced supplementary leverage ratio, or the ESLR, which builds on a broader SLR framework for the largest banks. So in simple terms, the rule limits how much banks can expand their balance sheets, regardless of the riskiness of the assets they own, back to the points we were kind of talking about here. So regulators are now making the ESLR less binding. And the argument is that the leverage ratio was never supposed to be the main capital constraint on banks. It was designed as a backstop to the risk-based framework. These changes are intended to restore that balance and make the overall system work more as originally intended by these rule changes. In addition, the stress tests are becoming more transparent. The U.S. version of Basel III, which takes effect in January, isn't necessarily a story of broad deregulation. And by regulators' own estimates, it still increases capital requirements for large banks, although some of that impact may be offset by changes elsewhere in the framework.
Yeah, Brad, one important question is why are we revisiting these rules now? The current regulatory framework seems to be working. The largest banks have been very stable, even during periods of extreme market stress, and also during periods when smaller banks experience significant volatility.
Yeah, I think that's clearly true, right? Banks now perform better during periods of market stress. That used to be very challenging for them. So there's a logical conclusion, and it's that this is because of the changes to their business models that they adopted after the new rules we just talked about took effect. Notably, they're taking less overall risk now, and particularly in their trading businesses.
Yeah, COVID was a good example of that. Remember, the markets experienced extreme volatility during the initial months of the COVID pandemic, but banks actually did quite well during that period. And then actually this year, there was a lot of volatility associated with the start of the Iran conflict. And once again, banks performed very well.
Okay, both true, but this is where I think maybe our views start to diverge a little bit. If you think about your COVID example, we only supposed to worry about banks not blowing up, or should we also be thinking about them being able to help the economy actually through a period of stress?
You know, Brad, I think if we're talking about banks here, if it ain't broke.
I know the rest of that sentence, but it might not be broken. However, regulations can be viewed as overbearing and overdone in parts. So I see the coming changes really as a somewhat overdue, let's call it a cleanup exercise, actually. These rules were all individually very well intentioned and, vacuum, most of them make sense. But so many rule changes so fast after 2008, we had to see how the pieces fit together. It makes sense that they don't all work perfectly.
Yeah, I mean, we've just summarized a couple of the big picture changes that occurred, but really at the time, it was an onslaught of new rules and regulations and a veritable alphabet soup of ratios and requirements on banks. I mean, I'll throw out some of the acronyms just to get a sense of them. LCR, NSFR, HQLA, SLR, et cetera, et cetera. I mean, the list goes on.
I'm actually proud of myself for remembering what all those initials mean. But the reality of it is, in some cases, those rules, as I was alluding to before, I just don't think they make as much sense anymore. And I'll give an example. And the limit on safe assets was built for just a different market environment. The assets that banks owned during the crisis, those don't even exist anymore. And banks just don't do those type of highly structured deals.
Well, I do think hindsight is 20/20. So we know that certain types of deals don't make sense. But of course, we don't know what the future holds about these kinds of transactions, going forward. And we are seeing some new forms of structured deals emerge. They do feel less risky, but they haven't been tested in times of stress. But to be fair, though, it is correct what you said that these requirements on banks regarding low risk assets, the ESLR, was originally meant to be a backstop, not the primary constraint on banks.
But it ended up being binding on the largest banks, despite the fact that the safe assets they own now are mostly treasuries and other U.S. government obligations like reserves held at the Fed, which really are truly safe. The same holds for other changes spurred by the GFC. These rules have been continuously evolving over the past 15 years as we learn how they work, and it's perfectly natural that at times that means revisiting some constraints. It doesn't always have to be the other direction.
I think where you're off here, Brad, is understanding the motivation behind the changes to low risk assets. So I think what we're missing here is another dimension, which is that policymakers are very worried about some recent episodes of dysfunction in the Treasury market. Now, keep in mind, the Treasury market, that means, U.S. government issued debt. That is supposed to be the deepest and most liquid market in the world. But really, over the past sort of 6 or 7 years, it hasn't always worked like that.
So there have been, I would call them brief periods of instability. I guess, in your 6 or 7 year time frame. There was one in 2019. We had some during COVID, and then during the regional bank crisis in 2023 when the market didn't function that well.
Well, they were brief periods of instability, but they were brief because every time that you mentioned, the Federal Reserve stepped in and stabilized the market. So the COVID experience is actually the most worrisome of all of those. Recall what was happening during COVID. Equity markets were selling off. People were panicking. Future of the economy at stake. In that kind of a market, typically what happens is interest rates fall.
Yeah, that's exactly what should happen, right? Investors should step in and buy treasuries because they're the safest assets. And the flight to safety should mean that treasury yields go down and prices go up.
Yeah, but the opposite happened because investors weren't just selling equities and other risky assets. They were also selling treasuries, and there was no buyers. The largest banks were constrained. They couldn't step in and buy those treasuries precisely because of the leverage ratio that was binding up. Now, fast forward 6 years. The U.S. government has issued trillions more in debt thanks to the huge deficits that we have been running and continue to run. The capacity to trade all these treasuries is even more limited now simply because the size of the market has grown by so much. And I think regulators are trying to shore the market up by revisiting these rules. Keep in mind a couple of recent developments. We have a new Federal Reserve chairman, and he has stated that he wants to reduce the Fed's footprint in markets. That means that banks are going to need to pick up the slack, but because of these rules, they couldn't. There's also been even more recent developments in Treasury markets that have required some policy intervention. For example, recently, the U.S. Treasury Department, working in sync with Japan, took some steps to stabilize the yen, in part motivated by fears that Japan would sell treasuries that they owned, and there might not be buyers for those either.
But I would argue that it's not just about banks there. Some of that is about the price or the yield of treasuries, whether you mentioned the example you just did regarding the yen. We think about some of the buyback announcements by Treasury as well. It's definitely about functioning in these markets, but it's also about the price, right? And so I think we can have different perspectives on the motivation and the changes may affect market functioning, but we just got to be careful not to suggest that it's going to return us to the bad old days of risky banks. I still believe that if we're talking about the things we're talking about, where there might be some market function episodes, right, but truly safe assets, it's quite different from what banks owned pre-crisis.
Well, I think what you're saying is true for this round of changes. And so far, everything that's been proposed, I think, fits with your narrative. And if you're right about the motivation, then it ends here, and I agree with your conclusion. But if I'm right about the motivation, this could be the first of several rounds of revisions, as policymakers are continually forced to choose between bank stability and market stability. And the reason goes back to all that debt we're issuing and the major deficits we're running, which is that the stability concerns may keep bubbling up as the government keeps issuing. For example, the SLR capacity has been created by the revision to the rules, will be used up in like 18 months, given the deficits that we're running today.
But we're talking about Treasury still.
Yeah, true. Some of the safest assets out there. But remember, interest rate risk is still a risk. And interest rate risk actually played a really important role in some recent episodes in markets. Silicon Valley Bank, for example, got caught holding treasuries unhedged as interest rates rose and they went bankrupt.
Well, ironically, I would say that was partly, at least, due to the limits we are talking about. So during COVID, deposits increased a lot, and large banks, they couldn't take all of them because they faced the constraints that we just mentioned. So smaller banks, which are generally less affected by this rule, they took the deposits. But they also are maybe less sophisticated at managing risks and are less heavily supervised. So it's not a surprise that a handful mismanaged those exposures.
All right, Brad. So what do you think all of these changes mean for banks and for markets?
Look, I think the biggest effect will be an improvement in bank profitability. And I kind of like to measure that as a return on equity. So before the crisis it was pretty high, kind of around 15, 16%. But since the new rules took effect, it fell a lot. We're kind of in the 9 to 10% range. And these changes should take some of the pressure off, which will be good for bank equity holders.
Yeah, well, I agree with that. I think that will happen. Mm-hmm. These changes allow banks to support more business with each dollar of capital. So they could do more trades, make more loans, et cetera. And all of that adds up to more profits. But I think that's only one effect. I also think that markets are going to benefit from all of this capacity.
I'm a little bit less convinced there. So if I look at our research, it shows that as returns have fallen, banks have reduced reinvestment and returned more capital to shareholders instead. So these rule changes will certainly create additional capacity, but capacity and growth, not necessarily the same thing. I think a lot of the benefit will show up higher returns, buybacks, and capital distributions rather than a meaningful increase in organic growth.
Well, Brad, it is true that reinvestment at the largest banks has been lower since the crisis. But isn't that just because their returns are lower? Like you said, return on equity has fallen. Banks are just less attractive as an investment. So the shareholders want their money back. They want the profits returned to them. But wouldn't that change if the returns bounce back up?
I'm not jumping to that conclusion, actually. Shareholders can be quite persistent about this. So let's take an example. Let's move away from financials for a second. Let's go to more of the industrial world. And let's think about what's happened in the energy industry, which historically is subject to massive booms and busts.
Yeah, that's right. Oil prices go up. Producers all invest like crazy. Then their capacity comes online. They produce all of this energy. And guess what happens?
Prices fall and they don't make any money. So shareholders have been trying to short circuit that process, right? Insisting on capital discipline, which means limiting investment during boom times and returning the profits instead to the shareholders. You're seeing much more discipline today than you would have seen in the past. We're in an oil spike right now. I think the same thing will happen here. If banks start reinvesting, their margins will fall, returns will decline as well. The only way to stop that, it's to keep reinvestment low.
Well, first of all, go back, a few minutes in this conversation. Remember, we were talking about all the bond issuance that's happening. As U.S. Treasury and other entities issue more bonds, the demand to trade and finance these low-risk assets grows. And I don't really see margins in that business being put under pressure. There's so much issuance, so much demand to trade and finance that stuff that I think all this extra bank capacity will be put to good use without actually forcing their returns down. I also think that there's, a risk angle here. So investors don't just care about returns, they care about risk-adjusted returns.
I can kind of see where you're going here, right? Volatility of bank earnings have fallen as the same time as returns have fallen, kind of what you'd expect. And, that's given their lower leverage, probably what should happen.
Yes, but the risk decline was smaller than the decline in returns.
Which is why shareholders demanded more payouts. The risk-reward trade-off got worse for large banks because the lower risk did not fully offset the lower returns.
Right, but if you feel strongly that at least this round of changes isn't going to seriously raise bank risks, which I think we both agree on, then risk might not go up as we change these rules. Like these modifications might not actually change the risk calculus, just the return calculus, which means the risk-reward trade-off gets better. Now, the largest regional banks, not like Silicon Valley Bank, clearly, which had its own issues, but the experience of larger regional banks, which went through that crisis reasonably easily, are informative here. They also experienced a decline in returns when the new rules after the crisis got adopted. But their risk fell by a lot. And guess what? The risk-reward trade-off improved, and
they now reinvest more than before. I give you that one. But I would still hesitate to extend that to the largest banks.
Okay, why though? That seems like a pretty good analogy to me.
I think if you step away from some of the financials for a second, right? Regionals adopted new payout policies really in an earlier era. And it's easier to stick with a high reinvestment policy than it is to actually institute a new one. So the challenge is that banks are competing for investor capital at a time when some of the highest expected returns, they're not being generated in the financial sectors. They're being generated particularly in AI-related sectors.
Okay, I think that's a good point. And ultimately, the question is whether these changes either just simply improve market functioning or really mark the beginning of a broader shift in how regulators balance financial stability against market capacity. But of course, Barclays tech analysts expect more than $1 trillion in AI CapEx by 2028. So there's going to be plenty of activity in equity and credit markets to drive return for banks. They can kind of piggyback all of this. Okay, sure, AI is like the main focus right now, but banks are not just total bystanders in what's happening in that sector.
Look, and that shows why investors are so focused on this, even if some of the best opportunities may be elsewhere. It's not whether banks necessarily become riskier, but whether a safer banking system can still provide enough capacity for a rapidly growing, just overall financial market. Something we're going to be watching very carefully and following how these rule changes ultimately affect banks. Jeff, I appreciate you coming back to the building and doing this with us. Clients of Barclays Investment Bank can learn more about this topic by reading our report titled Capital Call on Barclays Live. Thanks for listening, and I'll see you next time on the flip side.